Fab. Right, we'll get cracking then. So thank you everybody for joining. For those who don't know me, I'm Holly, the leader of the training lead at the Art of Finance, and I am very happy to say that it's not me speaking today. We've got John and from BNY Mellon, and we're talking about overcoming behavioural biases. And sound very interesting. I'm interested to see what you've got to say, especially when I think about the exams I've done, especially like, you know, RO2 or whatever it was. Absolutely not really funds and the management of them, not my expertise whatsoever, but behavioural of people, how people react, I always found that very interesting. So I'll leave it over to you, John.
That's great. Thanks for the introduction, Holly, and thanks very much everyone for joining us this morning. As Holly said, today I'm going to talk about some of the key behavioural biases and how we might be able to overcome them. I'll also make the long and short-term case for income investing with particular reference to the retirement market before finishing off with a quick look at the BNY Mellon Global Income Fund, for which I am one of the portfolio managers. So it is very clear that we are all susceptible to behavioural biases. And as portfolio managers, it's really important that we're not only aware of that, but that we also put in place processes to deal with them. Now, many people will tell you that they are aware of the key biases and that they take them into account. So in that sense, I may well not tell you anything that you don't already know, but I will describe to you what you might want to look for from an investment manager to understand what they are doing to overcome biases that are hardwired into our brains. So what is behavioural finance? To understand what it is trying to explain, we need to put it first into the context of traditional finance theory, which assumes that investors and markets are perfectly rational, that investors have perfect self-control, i.e. they are emotionless, and that they're not confused by cognitive errors. Behavioural finance seeks to introduce psychology to markets and to understand how it influences investor behaviour. It focuses on the fact that investors are not always rational. That's certainly not news to me. That there are limits to their self-control. Again, that is definitely not a shock. And that decision-making is very influenced by inbuilt biases. There are four key areas of behavioural bias: self-deception, social influence, emotion, and heuristic simplification. Looking at each of those in turn. Self-deception. We're all prone to believing that we know more than we do, that we are smarter than other investors. Often that leads us to overconfidence. Fund managers are in general a pretty arrogant bunch, and it means that we might miss important information that could lead to better decision-making. I actually saw a very nice quote the other day. We need to teach that doubt is not to be feared. It's okay to say, I don't know. That is absolutely not traditional fund management culture. Social influence. We're all influenced by others, both within organizations and outside. Colleagues, journalists, talking heads on Bloomberg. Everyone has opinions. Emotion. Who can really claim to be in full control of their emotions and not let anger or frustration influence their decision-making? And then heuristic simplification. Investment is complicated, not least because of the huge amount of information that we are constantly being bombarded with. How do you make sense of all of that? Do you use rules of thumb, take shortcuts? Those are heuristics. Now, I've shown here the top 10 biases, and I'm certainly not going to go through all of these, but instead I'll pick out a few and try to illustrate them with some examples. So first up on the top left there, overconfidence and the illusion of control. Now, at this point, I would normally ask you how many of you believe that you are above average drivers. It's not going to work so well in a virtual world, but if you are a normal group, and I have absolutely no reason to believe that you aren't, About 75% of you will say that you are an above average driver. Clearly, statistically, that isn't possible. And interestingly, a study that asked fund managers the same question, not about driving, about portfolio management clearly, delivered exactly the same result. 75% of us think that we are better than average, and the remaining 25% will only admit to being average. So that overconfidence leads to inappropriate risk-taking and a failure in particular to consider what might go wrong. Secondly, herding mentality, down on the bottom right now. Investors love running with the crowd. The expression when I started out used to be that nobody gets fired for owning IBM. They might do now, but the point is that it's safe to be doing what everyone else is doing. It's hard to take a contrarian view, and often you have to be forced to do that. Thirdly, anchoring bias. This refers to determining value based on the first piece of information you received. So let's imagine that you walk into a department store and by mistake you ended up in the designer section. You see a suit for £1,000. Later on, you see a very similar one for £250. It seems pretty cheap, doesn't it? And if you'd seen the £250 suit first, what would you have thought? It's the same with stocks. Valuation measures are often based on the current price rather than building up a valuation on a principles-based discounted valuation of that company. Finally, loss aversion. The research is very clear here. It shows that investors feel the pain of loss more than twice as keenly as they derive enjoyment from a gain. However, and this is the critical part, you don't feel that pain until you crystallize the loss, making it really hard to sell your losers and ending up potentially with a much larger loss than was necessary. Now, this is an example of a study which effectively looked at loss aversion. They examined 800 portfolios with an average size of approximately $500 million over a 5-year period and found a pretty striking result. There was clear evidence of buying skill. So fund managers are quite good at buying stocks, but the sell decisions underperformed substantially despite being taken just as frequently. So fund managers are much worse sellers of stocks than they are buyers. They actually even found that selling was so bad that you would have been better off just randomly selling stocks in the portfolios. So how do we overcome these biases? The conclusion from the academic literature is to focus on the process. And I will return to process in a moment. But before I do that, I first wanted to return to heuristics. Why do investors use heuristics to simplify things? As I said, we're overwhelmed with information. And despite the dangers of overconfidence, we can never know everything. Something could always come along to blindside us. Investing is about probabilities. Therefore, it makes sense to try and lean the probabilities in your favor and to focus your process on areas of the market where the odds are stacked in your favor. So bringing in a sporting analogy, unfortunately, a lot of the sporting analogies in investment are all from baseball. Americans love talking about baseball. And if you're like me, you find baseball completely impenetrable. It may not actually mean anything. But the point from the quotes here is that the key to success is defining your universe. Only swing when the odds are in your favor. As Warren Buffett pointed out quite a long time ago now, the difference between baseball and investment is that in investment, if you don't swing, there's no 3 strikes out and you're 3 strikes and you're out rule. What's more, as Jeff Bezos highlighted much more recently, investment gives a much wider range of potential outcomes than baseball. He highlights clearly the potential upside, perhaps not surprising given how successful he's been. But we would also caution about the potential risk, the potential to lose money. The key is that it pays to be patient and disciplined, and by doing so, to improve your chances of success. and to clearly define your universe. How should you define that universe? Well, one option is to focus on dividends, to focus on income. Why would you do that? Well, dividends are important for a number of reasons. They encourage disciplined capital allocation by management teams. Vanity projects are much harder to justify if you have a dividend to pay to your investors. There is very good evidence that capital discipline leads to higher earnings, to better growth. A study by a couple of academics in the US showed a positive correlation between the payout ratio, so the amount of your earnings or your cash flow that's paid out in dividends, and the subsequent 10-year earnings growth. That's actually, if you think about it, quite a surprising result. The more of its free cash flow that a company paid out, the faster it subsequently grown. Many people think that the key to success is reinvesting everything in the business. But actually, if you have the dividend plus good disciplined capital allocation, that's what leads to better growth. Dividends can be used to highlight value. An attractive dividend yield is a decent starting point for uncovering attractively valued companies. It does seem a bit strange to be saying this after what we saw in 2020 and the impact of COVID, but statistically and typically dividends are a really reliable source of return. And that over the long term has made them a really important part of the returns that investors receive from equities. And that's what's illustrated on this chart, which comes from Professor Schiller at Yale. It goes back to 1900, and it really picks up on those last 2 points. Through the middle in grey, you can just about see it, that is the consistency of dividend returns, really, really steady. You contrast that to the green bars, though, which are the capital returns. Those are clearly a lot more volatile. It's the lines on the chart which really highlight the importance of the reinvestment of dividend income to long-term returns. So if you simply relied on capital, $1 invested in 1900 would have been worth $528 by the end of 2019. But the total return with the reinvestment of income would have been $73,000. Clearly a quantum difference. It was Einstein who once said that compounding interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays. And this chart, I think, clearly illustrates that it is the compounding of dividends which is the dominant source of long-term equity market returns. What's more, further research, this is time from the Centre for Endowment Asset Management in Cambridge and the University of North Carolina. They found that investing in higher yielding portfolios gives superior returns to investors. Now, as an income investor, it absolutely hasn't felt like that over the last decade. But over almost 90 years, a high dividend yield portfolio outperformed both low and zero dividend yield portfolios by around 2% per annum and 3.3% per annum, respectively. Dividends are key to delivering a total return. There is a catch, however. There's always a catch. Just as with the dartboard, unless you're a professional, aiming for triple 20 doesn't actually make sense. You're just as likely to hit the 1 or the 5. It might look attractive, but actually statistically, you're better off aiming at the 7, potentially hitting the 16 or 19 for a much higher average score. And that principle of optically attractive versus statistically attractive also applies to dividends. The highest dividend yield might look attractive, but they're very often cut and you don't get what you expected. And that's before we consider the impact on your capital following dividend cuts. And interestingly, that research paper from Cambridge stripped out the highest 5% of dividend yields for precisely this reason. It distorted the results. So statistically, you're much better focusing on companies paying a premium level of income to the above the market, but at the lower end of that premium. And that is a key reason why income investing needs to be active. So we've established that to overcome behavioral biases, you need a disciplined process, and that in a complex world, focusing on dividends can help to lean the statistics in your favor. Now, we are not superior beings, and although we may often be guilty of overconfidence, we know that ultimately we aren't much cleverer than everyone else. So we actually can't afford to ignore the opportunity to benefit from the probability and lean the statistics in our favor. So what I'd like to do now is to move to look at how you could put together a process to both help you overcome biases and enhance the power of dividends. But taking a process that is close to home, let's imagine that to be able to buy a company, it must yield 25% more than the market. And if the yield falls below the level of the market, then it must be sold. Why would you do that? Well, because every stock has to pay a premium level of income, by definition, every stock has to have a yield higher than the market, then you will benefit from the eighth wonder of the world, because you're always compounding a higher level of income than the market. It also removes the temptation to barbell the portfolio, generate a premium income by combining some no income stocks with some of those very high yielders, which, as the previous slide shows, can be very dangerous. If there is a failure of analysis and a company cuts its dividend, it will very likely fall below the level of the market, and you will be forced to overcome your loss aversion and sell the stock. And it imposes a valuation discipline on the process, which often forces you to look for ideas in out of favor areas of the market, thereby overcoming the temptation to run with the crowd, overcoming herd mentality. It's critical to make sure that you focus on sustainable dividends, to make sure that you focus on the statistically attractive rather than the optically attractive. Three key elements to that sustainability, being on the right side of thematic or structural change, the fundamentals of a business in terms of its cash generation, its balance sheet strength, its competitive position, etc., and making sure the company has the right governance structure to ensure good capital allocation decisions, as well as no environmental or social reasons which call into question the long-term sustainability of the dividend. And then finally, to overcome anchoring bias, it's important to carry out detailed and consistent analysis across the portfolio to establish what we would call a valuation margin of safety. Nobody can predict the future, so use discounted cash flows to carry out detailed bull, base, and in particular bear scenario analysis. Think about what might go wrong and lead to a dividend cut and a sell at the wrong time, to highlight an asymmetric risk return profile where that asymmetry is in your favor. Finding stocks with a premium level of income that is sustainable and where there is that valuation margin of safety only happens when there is some sort of disagreement in the market. So at Newton, we break the income universe down into buckets of controversy. And when I come to look at the portfolio later, I will return to those buckets. But first, I want to ask the sort of pretty fundamental question: why is an income strategy relevant now? After all, until very recently, at least, it's all been about growth, hasn't it? Certainly since COVID, when pretty much regardless of the investment backdrop, the same stocks have been leading the market, the obvious beneficiaries of COVID, large cap US growth stocks. So much so that in April of 2020, NASDAQ as an index became more valuable than the entire rest of the world, the real economy, if you like. Now, in itself, that is pretty remarkable. A single country, technology-dominated index being worth more than the rest of the world. But when you consider that 7 or 8 stocks, the FANG stocks, Facebook, Apple, Amazon, Netflix, and Google, along with Microsoft, Tesla, and Nvidia, make up more than 50% of the value of NASDAQ, you realize quite how narrow market leadership has been. That's been a very tough backdrop for an income strategy, because for those companies, only Microsoft and Apple pay dividends and neither offer a premium level of income. But whilst this that growth dominance has been going on, they've also, on the right-hand side, enjoyed a significant re-rating, with the PE ratio on growth stocks expanding, whilst the valuation of value in income stocks has pretty much gone nowhere. But that's perhaps not surprising, because dividends, normally such a reliable source of return, were also cut. And we saw the distribution from the global index down about 15% in 2020 relative to 2019. But it was a pretty extraordinary year. You know, it was a health crisis. It wasn't a standard recession. Normally reliable dividend payers ended up cutting for all sorts of reasons, for financial reasons, you know, inability to pay, but also social reasons. For instance, Inditex, which is Zara, effectively, they didn't think it was right to reward shareholders and furlough their employees at the same time. We also saw financial regulators, particularly in Europe, telling banks that they couldn't pay dividends, even if they were financially able to. Having said that, if you look at the sector chart on the right, you know, it was the more cyclical sectors like autos, travel and leisure, consumer discretionary, which saw the largest dividend cuts. Traditionally more stable sectors, insurance, telecoms, food retail, etc., fared much better. And healthcare actually was the standout. Dividends actually rose in 2020 in the healthcare sector. The regional level, only really the US outperformed. There's a bit of an anomaly there. The US has a preference for returning cash to shareholders through a combination of share buybacks and dividends. The share buybacks were cut. That enabled the dividends to be reasonably maintained. But overall, it's been a really challenging period for equity income strategies. Which brings me to investing in retirement. How should investors approach the issue of retirement income in an environment where there's a lot of pressure on dividend-paying companies? I've shown here the three main approaches that, of course, you're all very familiar with. Total return, realizing income by selling investments. The bucket approach, whereby the account is segmented to meet future income needs. And the income-driven approach, where income payments are met by the natural income generated by your investment pot. No prizes for guessing which one has been falling in popularity. It is, unsurprisingly, the income approach, with 25% of advisors saying that they use it either always or most of the time, down from 33% in 2018. And compared to 39% that use the total return approach, which has risen from 2018, when at that starting point, the three approaches were pretty much equally popular. To add insult to injury, from my perspective, 26% of advisors say that they never use an income approach. However, in the words of this independent report, income strategies still have a really valuable role to play in retirement investment, not least because they provide an opportunity to participate in growth whilst limiting downside. And we can illustrate that with some timeline modeling. Reducing volatility helps with certainty. A 6% return with a 10% standard deviation gives you an 80% chance of success. In other words, not running out of money in retirement. If volatility increases to 15%, your chance of success is reduced to 63%. The lower volatility approach also reduced the range of outcomes, making it easier to target a specific legacy requirement. But you also need a return. A 4% return with a 4% standard deviation gives you a 62% chance of success, a 38% chance of failure. It underlines the fact that in retirement, you do still need to balance risk and reward. Being too cautious, just investing in fixed income won't get you there. And in particular, you need to focus on downside risk and perhaps be prepared to give up some upside to reduce that downside risk. And that is where equity income comes in. And things are getting a lot better. The news about dividends has improved significantly. Actually, it has been since the middle of 2020, with many companies reinstating payments. Inditex was quick to return to paying dividends once lockdowns had ended, and the regulators have allowed banks to pay dividends again. And that trend is set to continue. On the top left there, balance sheets have been repaired, with cash increasing across all regions. And as a result, dividends are very well covered. And the strong momentum that we saw in dividend growth last year is set to continue through into 2022. That's important because investors that need income have relatively few options. Bond yields have risen somewhat over the recent past, but there is still pretty limited income being provided by other asset classes. You add to that the demand for income driven by demographics, increasing retiring populations, very encouraging for us as income portfolio managers. And yet, on the bottom right, the valuation on income stocks is very attractive. They are still trading on an historically wide discount to the market. What will be the catalyst for the market to take this valuation opportunity? The key is bond yields. Rising yields are positive for income stocks. Why might that be? Well, the answer lies in the overall structural and thematic backdrop. The key structural changes, the key themes remain the smart revolution, the rapid pace of technological change, humans being replaced by robots, the fact that we are doing this conference over Zoom. Earth matters, the energy transition from fossil fuels to green energy. Population dynamics, the pressure that aging populations are placing on healthcare systems. And state intervention, the action of central banks and governments in the form of quantitative easing and zero interest rate policies has driven markets really since the financial crisis. However, things are changing. QE is finished and interest rates are rising. Why? One word, inflation. We are entering, in our view, a new era, leaving the deflationary decade behind us, because we believe that the sheer scale of state intervention during COVID, the supply chain bottlenecks that were caused by COVID, which have been exacerbated by the tragedy that's unfolding in the Ukraine, mean that the next decade is likely to be an inflationary one. Sure, some of the recent rise in inflation is transitory. We don't expect inflation to continue at 7-8%. It will moderate as some of the supply chain bottlenecks will ease. But we don't expect a collapse in commodity prices. And importantly, wages are rising with more deep-seated inflation. And crucially, inflation has become a major political issue. The cost of living crisis is a key factor in European politics. And the US president, Mr. Biden, is unable to get his flagship Build Back Better policy through the House because it's being blocked by a Democrat, member of his own party, who won't countenance a significant increase in spending at a time when his constituents are being squeezed by inflation. But as a result, interest rates are going up, and it's very noticeable that the performance of income stocks has been much better since Jay Powell, the governor of the Federal Reserve, made a key speech at the end of November when he highlighted that QE was over and that rates were going up. Falling yields have been very positive for growth stocks. The discount rate used to value future cash flows has only been going down. Well, now as that is changing and as the discount rate rises, that will be much more negative for the performance of growth stocks, much more positive performance of income and value stocks. And income stocks have the added benefit of being able to protect you from inflation, given the close correlation between dividend growth in blue and inflation shown here in gray. Generally, as inflation rises, so do dividends. So, dividends are recovering, valuations are attractive, inflation is picking up, and interest rates are rising. Now, we believe, is the time to revisit an income approach to investing, which puts the disciplines required to overcome key behavioural biases at the core of its process. In other words, the BNY Mellon Global Income Fund. So just a couple of slides, both on what the discipline has done in terms of the benefits it's provided to our investors, and then the positioning of the portfolio. So the benefits, two key things, I think. Firstly, it has driven us to buy quality at a reasonable yield. But just to explain what I'm showing on this chart, across the top are the style characteristics of companies when we buy them. Across the bottom, the style characteristics of companies when we come to sell them. And what you see is at the time of purchase, there is a clear bias towards quality in terms of returns, margins, etc. A negative growth bias. We're not buying the fastest growth businesses in the market. And unsurprisingly, a positive yield bias. This is the dividend-driven strategy. And on the right-hand side in dark green, a clear value bias. So the stocks are cheap. When we come to sell them, quality bias is still there. The growth has improved, actually, mixed now. The yield bias, interestingly, is still there. But what's gone, dark green has gone to light green, the value bias has gone. So in essence, what we are doing through our process is buying good quality companies when they're cheap and selling them when they're not cheap anymore. It sounds simple, not actually that easy to do, and it requires you to overcome some of those key behavioral biases that I discussed earlier. Secondly, it's produced what we would argue is a very attractive asymmetric return profile. So again, just to explain the chart, the grey bars are the performance of the strategy in quarters when markets were rising. The green bars, the performance of the strategy in quarters when markets were falling. What you see is that we typically struggle to keep pace with rising markets. We're prepared to give up some of the upside to protect capital when markets are falling. And we almost invariably outperform in down markets. And it's the job we do of protecting capital when markets are falling, which is the key to the compounding up of the excess return. On the right-hand side, the COVID quarters, for the market leadership and dividend cut reasons discussed, we were disappointed by the scale of the bars, particularly in 2020. Although, as I've been discussing, this significant change in the backdrop that has come through did lead to very strong relative returns since the speech at the end of November. We are confident about the fund's positioning as we move now beyond the COVID crisis. So how is the fund positioned? Well, earlier I mentioned that finding stocks with a premium level of income that is sustainable and where there's a valuation margin of safety only happens when there is a controversy in the market, and that we therefore break the portfolio down into buckets of controversy. And I've shown the portfolio on this slide by those buckets, be they troubled compounding machines, businesses with high returns, good cash generation, where there is a temporary issue that the market believes is permanent. But in reality, the underlying power of the business is underappreciated. So just to give you an example, earlier this year, we bought Medtronic, medical device company. They make pacemakers, diabetes products. It's the first medical device company we've been able to own in the strategy for a long time. So the first time a company like Medtronic has had a premium level of income for a number of years. Why? The market is absolutely obsessed by the fact that hospitals have been filled with COVID patients, and therefore elective procedures like the fitting of a pacemaker, for instance, have been delayed. But the key there is delayed. They are going to happen. They've been delayed by COVID. As we come out of the COVID situation, then those procedures will start to take place. That gives us an opportunity to buy a high quality business on a depressed valuation for a temporary phenomenon that's depressing the valuation. The second bucket, ex-growth cash generators, very similar, high returns, good cash, but where the growth has disappeared, but the longevity of the business's returns are underappreciated. Capital intensive businesses where the returns are much more modest, but they have the ability to consistently deploy capital at a rate above the cost of that capital, and therefore sustain a dividend stream, for instance, regulated utilities in the US. Or finally, profitability transformations where returns are much more cyclical, and therefore inconsistent, but the business is currently under earning and there's nothing in the valuation for a more normalized environment. So for instance, we own Volkswagen. Volkswagen by 2030 will be one of the largest producers of electric vehicles in the world. Currently, volumes are depressed by supply chain issues, particularly around semiconductors. And unfortunately, those have been exacerbated in that a lot of the supply chain comes from the Ukraine. But demand will recover for new cars. And yet the stock is trading on a PE of around 5 times. And for comparison, Tesla's on over 100 times. Now, clearly, Tesla doesn't have a legacy internal combustion engine business, but that valuation gap only needs to close a little bit for Volkswagen to be a very much improved performer. As a general rule, as you move across the chart, the weightings come down. That reflects that dividend sustainability and valuation asymmetry get harder to assess as business become more cyclical. And in addition, you should expect the core of the portfolio to be in the first 2 buckets of those stable cash generative businesses that are able to support sustainable dividend streams. And that's exactly what you see on this slide where I've shown the portfolio along much more traditional lines. First of all, it's quite deliberate that the stocks are in pride of place on the left-hand side, then the sectors, then the geographies. It's stock selection which drives the portfolio. There are 52 stocks in that portfolio. It is concentrated. As a team, we back our conviction, but importantly, it is highly differentiated from the index and from the typical global growth portfolio. 0 weightings in Apple, Microsoft, Amazon, Alphabet, Tesla. You know, this is clearly not a FANG portfolio. There is no herd mentality going on here at all. Core of the portfolio in stable compounding businesses, as I mentioned, overweight positions in consumer goods, healthcare and utilities, underweights in commodities and more cyclical areas like industrials. And over the last 18 months, 2 years, the weighting in financials has increased significantly, reflecting our view on inflation and bond markets, as well as attractive valuations in the sector. Overall, a committed portfolio with stability of cash flows, dividend sustainability at its core. And for those of you that are increasingly being asked about sustainability in an ESG sense, we also have a sustainable version of the strategy, which was launched in 2018, now over £100 million. And clearly, you know, we would be delighted to talk to you about that at another time. So in summary, we're all vulnerable to behavioural biases. To force yourself to overcome those, you must focus on having a disciplined process. Over the long term, it is the compounding of dividends which drives returns, so focus on income to lean the statistics in your favour. Reducing volatility is important in retirement, and an equity income approach offers the ability to participate in growth whilst naturally offering downside protection. Think about that asymmetry of returns. And over its almost 16-year longer history, the BNY Mellon Global Income approach has proved that point, delivering higher returns than global equities with lower volatility, which is exactly what we set out to do. Thank you very much.
Thank you very much, John. I do love a scatter graph, scatter chart. They're always in my reports. Show my point. It is interesting when you're on about the retirement options, because I remember when I first started, so as an outsourced power planning, we obviously a lot of different advice. And I used to always think, why are all advisors going for accumulation growth all the time in retirement and when they want income? And I never, well, to be honest, seen it a bit more, but beforehand, I'd never seen income portfolio in a retirement plan. But when you're reading it from like a textbook, you're like, why?
Well, it's not surprising. I mean, you know, if you think about the last decade or so, then it's all been about capital growth. So, you know, you can see why people have been drawn to more growth-related strategies. And as you know, as I've highlighted, until very recently, that's been exactly the right thing to do. We think there is an important sea change going on now, and that a more inflationary world will put pressure on those stocks, both from a valuation perspective, but potentially also from a demand perspective. You know, to look at Netflix yesterday, shares are down 35% on the back of reduced subscribers. Why are people not subscribing? Because their wages, although wages are rising, inflation's rising faster. So the cost of living crisis is putting pressure on consumers, and they are cancelling subscriptions like Netflix, for instance. They can't, it's not an expense that they can justify in a much more difficult environment. And it was a highly rated stock. So if you're relying on growth in retirement at this juncture, then I think that, I would consider at least introducing some natural income to the mix.
Rob, I do have a question from Dan. He says, do you have thoughts for how advisors should best approach biases with their clients?
Yeah, I think that that's a really interesting question. We were talking about it this morning, actually, that from our own business, we see periods when markets are strong, we see inflows. And periods when markets are weak, we see outflows, and that kind of reflects, I think, the natural bias of people. They want to, when they see success, they see things moving. They herd mentality. They want to invest more when things are going up. I think one of the key things is just educating and talking to your clients that sometimes when markets fall, that is actually the opportunity. Because over the very long term, equity markets tend to go up. And if you think about the asymmetry chart for our own strategy, a lot of the bars are grey. Typically markets go up. Occasionally they go down. When they do, those are the opportunities that you want to take. So I think just educating that volatility is not always a bad thing. Volatility equals opportunity.
Oh, I'm wondering if there's an opportunity there to create some case studies, some nice little infographics to give clients or something. I think examples are always best to get people, because even after the financial crisis, I think from that happening, then COVID, we even saw clients reacting a lot differently because it's been the lifetime that it did before. So I think, seeing examples, going through it with clients, I think that would definitely help. Nicole has asked, how important do you think the discussions of these biases are in relation to advisors with clients? Is this adding more jargon to the client discussions, or do you think it's important to talk through this to make people understand it better, or should it be left to clients to research on their own? I think definitely discussions, but what's your thoughts, John?
I think that it is something, it's, there are lots of buzzwords in there, aren't there? Like heuristic simplification, which is kind of easy to write down and not actually that easy to say, as I stumbled over it myself. So potentially it is something that just adds further complication to discussions. But by the same token, I think when you break it down to some of the examples, they're things which people can relate to very easily. We're talking about markets going down, people feel losses twice as keenly as they derive satisfaction from gains. So just, that in itself is an example for why you might want to take advantage of downdrafts in markets to invest more rather than to panic, because you're inbuilt to feel the pain of that loss rather than be excited when your investments are going up. But I also think that, relating that back to process, and, as I've gone through, I've been working at Nenton since 1995, and the longer my career has gone on, the more and more important I've realized the discipline in fund management processes. So, I think that when you're talking to clients and explaining to them what's happened to their investments, it's much easier to explain why a disciplined process might not have had such a good time over the last period, but why you have confidence in it going forward, and why you've allocated some of your clients' wealth to that strategy. And therefore, if it helps to then explain to them, the importance that discipline has in relation to some behavioural biases and why that's better than some other very momentum-driven strategies, then that could be a helpful discussion, I think.
We have run out of time, but I do want to squeeze one more question in, because I'm just thinking of clients. And as you mentioned, inflation is a massive issue for clients at the moment. How do you think that's going to pan out in relation to any assets? Do you think it's going to be favourable for some assets, or do you think some assets are going to suffer?
Yeah, I think that, classically you would think of equities as being a reasonable hedge against inflation, and fixed income securities as being much more vulnerable, because there's a capacity, as we said, for dividends to grow with inflation, while coupons on fixed income securities will remain fixed unless you're in inflation-linked securities. So I think it's better for equities than it is for bonds. But the knock-on impact of rising bond yields also impacts the valuation of some parts of the equity market, in particular the growth stocks. If you kind of take it to, if you think about the valuation of a business like Amazon, for instance, has been driven off the fact that you can see the growth of the business into the future. You've got this cash flow profile that you can see. You need to kind of work out the value of that cash flow now. So you use a discount rate based off the bond yield. And if the bond yield's going down, then the discount rate goes down and the value of those future cash flows goes up. You take it to its sort of logical conclusion, the bond yield goes to zero, Amazon's worth infinity. Clearly that isn't logical, but the same token, as the bond yields start to rise, the discount rate goes up, then some parts of the equity market are very vulnerable to that. And it is the areas which have led markets higher. It's the areas that if you invest passively, you will be heavily exposed to because they're the biggest companies in the world. So equities, I think, will do better than fixed income in an inflationary world, but it is important to focus perhaps more on the more contrarian, the more income and value ideas in that environment.
Thank you very much, John. It's very interesting. And thank you everyone for joining as well.
Brilliant. Thanks very much.
Thank you. See you later.